Okay, well, we'll get started. So welcome everyone to today's webinar, The 7 Ways to Grow Your Business. My name is Ikra Aslam and I am one of the client managers here at Rawls & Associates. And I'll be your moderator today, overseeing the running of the webinar and collating any questions we have along the way to answer them at the end. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. You can select audio settings to select and test your speakers. Submit any questions you may have throughout the webinar using the Q&A button. All you have to do is type in your question and we'll answer as many questions as we can at the end of the webinar. You can click Leave Meeting if you need to leave at any time. When you do leave the webinar, there will be a questionnaire that will pop up, and we would really appreciate it if you could spend a couple of minutes just filling in that feedback form. Now, I'd like to introduce today's presenter, Ian McLeish, who is one of the directors at Rawls & Associates. Welcome, Ian.
Thanks, Ikra, and thanks everybody for taking the time to come along and be here today for this webinar on the 7 ways to grow your business. Now, I always like to start with one or two thoughts, which I try to pick to capture the essence of what the webinar is about. So today, I picked a couple there, hope you can see them. The secret of getting ahead is getting started. And the secret of getting started is breaking your complex, overwhelming tasks into small, manageable tasks, and then starting on the first one. That was Mark Twain, and a much shorter one from Peter Drucker. What's measured improves. Now, these capture the idea that breaking down a big thing like growing your business into small parts and then starting measuring them is what this is all about. So what I'm going to do is focus on a simple way to model financial improvements in your business, i.e. creating a model that you can then use to show you what will happen in your business if you do certain things. Now, I've talked about goal setting and how to make the required changes in your business in previous webinars and seminars, and you can find them all on our website. This one, as I say, is to show you a simple way to build a financial model which you can use to grow your business. So this is the agenda. And what I find is one of the biggest problems in small businesses is failure to implement, or often called FTI. So if you don't write down what you're going to do, your actions, you won't remember them. Just like if you don't write down your business goals for next year, you'll be far less likely to achieve them. I mean, as we want you to get the maximum value from this webinar, I really encourage you to, if you've got any questions, please put them in the box. We'll deal with them at the end, but do write down any notes and points as you go. So we'll briefly cover basically what it is about you have to do in order to change. And one of these things is to making a choice. Then we'll look at getting the roadmap. So you're going to go from where you are now to where you want to be. So you have to develop a plan how you're going to get there. And once you've done that, you have to then have a dashboard which tells you basically if you're on the way, if you're getting there. Then we'll look at a worked example of the 7 ways, which demonstrates how you can make really small adjustments to your business, but the compound effect on the bottom line and cash flow can be really significant. Then at the end, we'll decide what you're going to do. You have to decide what action you're going to take as a result of coming along today. If you have any questions, as I said, during the webinar, send them through and we'll make sure they're all answered at the end. So, choosing to change, the first thing on the agenda. And we're looking at the 5 A's of change. Now, in our last webinar, we looked in some depth at what is required to make changes, whether in business or in life generally. And if you want to delve a little bit deeper into the change process, I'd recommend having a look at the recording. And you can access, as I said earlier, you can access it on our website. So it's fair to say we've all been through quite a bit recently, and it's likely that you now need to make some changes in your business, but it won't. Change won't happen on its own. You have to make the choice to change. You're in control of how you respond to the recent crisis, and there are generally 5 steps in the process. The first step, awareness, is basically being aware that you need to change. Now, there are some people who just think you just carry on as usual. So they haven't taken that first step to make the change. They're not aware that they need to change. And it's unlikely that your business has been able to continue exactly as it was before. And you do, so you have to become aware of what changes you need to make. The next step is to accept that you need to change. Now, you might be aware that you need to change, but you might say, but I'm not going to. So now the next step is accepting. What steps do you need to take to enable the change to happen? A lot of people get stuck here. They might go into panic mode and crisis mode and run around and make some immediate changes, but then to slowly go back to their old ways. So what actions do you need to take that are different from the ones you're doing now? To make sure that you do take action, the next step is accountability. What that means is essentially, you know how if you at school you didn't have a teacher that was going to hold you accountable for doing your homework, would you have done it? Well, some of us might have some of the time, but unlikely that it would be to the same level that it did happen. There has to be someone there who's going to be independent, who really does make things happen. And finally, you've got to take time. Once you've made the change, you've got to take time to acknowledge the change that you've actioned. So if you've got a team, take them with you, explain what's happening, get their buy-in, if you like, to what's going on. And then when they do things and when you achieve things, give some positive reinforcement, celebrate the change. Okay, the second item on the agenda is getting from A to B, your plan, essentially. So before you can actually make this plan, you've got to know where you are. That's point A. And the impact of the COVID situation means that it's likely you're further away from your destination than you would have been. So point B, where you're trying to get to, might be harder to get to now. It's likely that your original point B is still possible, but it may take a bit longer, or the route to get there might look a little bit different from what it did back, say, January, February time. So let's say, for example, before COVID, your point A might have been, we've got a £25,000 overdraft. And your goal was to reach a point B of having, say, £25,000 in the bank. And let's say you said, we're going to do that in 12 months. So you'd have to increase your bank account by £50,000 to reach point B. So that's what it was like. That was your original plan. But you probably haven't got that now, given what's been going on. So what does your point A now look like? Maybe you've had to get a bigger overdraft, maybe say another £15,000 or so to cover your expenses over lockdown. So point A is now a 40,000 overdraft, and the journey to point B is increasing your cash in your account by £65,000. So there's been a change in your plans because point A, your starting point, has changed. And it actually might be more realistic to say, well, let's do this over 2 years rather than 1 year. So do you know what point A looks like in your business, what you are now? And what's your goal for point B? Do you know what point B is? Do you know what it will look like? Again, going back to goal setting, what we see, what we hear, what we feel at the time. And what does the journey to get there look like? So now you know where you are as a result of COVID, and you know where you want to go. You need to revise your plan. This could be reviewing and updating your existing business plan. You maybe did in January. It's often when people do a business plan for the next 12 months or the start of your financial year. Now, it could be, if things are really bad, you might have to do a business recovery plan, which is a lot more details. And I'll give you a little bit of information about that in a minute. The impact on your business has been minimal. And a lot of businesses, we deal with a lot of businesses, and we've seen a whole range of reactions and consequences of COVID, from closing down to doing really, really well. So it's been minimal. It's likely you just need to update your business plan. You just need to make it seem more context to your current position, and just say, well, okay, we're not quite where we were, but let's look at it and let's plan a bit forward. If your business has been really badly impacted, we would recommend what's called a business recovery plan. And what this does is it helps you to revise your personal budget, so that to see if you can take less money out of your business and reduce the pressure on your business's cash flow. Then we determine whether there's any additional finance needed, looking at your cash flow and going forward. It might be the bounce back loan has been extended. So it might be, if you didn't take it early, you might look at it now and say, well, actually, it would be a good idea. And then you can also revise your business budget and your break-even analysis. And with a business recovery plan, you'll also look at your KPIs to monitor at this time and identify any opportunities, vulnerabilities, critical challenges. And then you'll identify your risks in each department of your business, as well as any sort of mitigation strategies that you need to take. And then set annual 90-day goals to ensure you achieve your plan. So we are going to get on to the 7 ways, but these are important sort of preambles to it to make sure that once you've got these in place, you can then look at how you're going to grow your business. So we looked at the plan, now we're looking at the budget, and this is the financial part. So when you work out your budget, the first thing we do with clients is start with the profit you need your business to deliver to you. Now that can take a little bit of work to find out exactly what it is. It needs to cover tax, it needs to cover dividends your limited company, has to cover loan repayments, maybe asset purchases, that type of thing. So you have to work out what your profit you need from the business. And then you can work backwards from that to what your sales figure needs to be in order to achieve that profit. So here's an example. Let's say in the past, you needed £75,000 for your target profit for your business to deliver what you want. And being in lockdown might have shown you that you can maybe live on a bit less. So you've revised your personal budget, so you can take a bit less out of the business, which means that you need only 65,000 profit target to reduce the pressures on your business. Your overheads were 175,000, but after leaving no stone unturned when reviewing your expenses, you might be able to trim this down to 162,500, as it says there. This gives us a gross profit target of 227,000 rather than the old one of 250,000. Now, if we keep our gross profit percentage, I'm not going to say too much about growth. If you want to find out a bit more about some of these terms, because I appreciate not everybody's familiar with them, go and have a look at our Know Your Numbers webinar, because that explains this in a lot more depth so that you can actually understand all these terms fully. So basically, if we keep the gross profit percentage at 39%, that means that in the old business, we needed £641,000 of sales, but in the new situation, we only need 583,000 sales. But while this is a bit less, we might have to have quite a close look at our expenses, etc., to ensure our goal is attainable in the current climate. So, of course, you need to break this down and look at this in a lot more detail than is on here. You basically want into monthly targets and an annual target, and then have actions as to how you're going to achieve these numbers. But you can see by having your profit worked out, then you can work backwards or upwards to find out what sales you need. And then if you're let's say you've got 52 weeks in the year, you can break it down by 52 to find out roughly what your weekly sales are, or monthly, depending on your business. So, as I said, you've got your plan, you've got your financial numbers, you know what numbers you need to hit. Now you need to know how to create something that will tell you whether you're actually achieving the things that you need to achieve to get to your goal. And this is the dashboard. Just like the dashboard on your car, it tells you how fast you're going, how much fuel you've got left, the engine temperature, etc. It gives you an indication about whether you'll make it to your destination, and it's the same in business. The things on your business dashboard are called your key performance indicators, or KPIs. And what they are is essentially the measures that tell you if you're on track to achieving your plan. So what should be on your dashboard? Well, it should be the top 4 or 5 measures that will drive most of your business improvement. By focusing on a small number of KPIs, you can capture, monitor, report, and improve them on a regular basis. Have too many, and it just becomes information overload. But you have to pick the right ones. And the right ones will depend on the type of business you have, as well as your goals. So, for example, let's say you're a manufacturer. You make things and you sell them. So what KPIs might you have? Well, first one might be gross profit percentage. Now this is, in a lot of businesses, this is the most important KPI. Not your net profit, although obviously that's important, but if you maintain your gross profit percentage, you're much more likely to achieve your targets. So what affects your gross profit percentage? Well, your selling price and the cost of making the thing, if you're a manufacturer. So how could you improve your gross profit percentage? Well, you can improve it by improving your prices or reducing your costs. So, there's different things you could possibly do. You might look at things like, let's say, your suppliers. Maybe change your suppliers to get some discounts, etc. You might stop giving discounts on your sales, but we can come back to that later. What else might there be? Well, cost of rework, that's might be a really important one to measure. You know, how much essentially wastage, how much stuff is having to be redone because it's not up to standard. That would be a really good one for a manufacturer. The other one might be work in progress days. So in other words, what's that? That's essentially the stuff that you've made that's sitting in the warehouse that you haven't actually sold yet. Obviously, if that gets too high, that ties up cash in the business. So you want to keep a track of that to make sure you don't end up producing so much stuff that you have to get another warehouse, and you're actually paying for this. And the last one might be debtor days. The debtor days are basically you've sold the stuff, you've invoiced it, but you haven't been paid yet. So by keeping that to a minimum, in other words, getting paid quicker, that could really improve your business's cash flow. So these might be, they might be good KPIs for a manufacturer. For a retailer, sales figure might be a good one. Basically, just monitor your sales. I mean, some big retailers monitor it by the hour. What are your sales by the hour, and start moving stuff around and doing things almost in real time. But for a smaller business, it's probably weekly or more likely monthly that you look at your sales figures and you have targets for that. You might have gross profit percentages in a similar but slightly different ways you would as a manufacturer would. The average client spend, how much does the average person spend when they come into the shop, say, or come into your business? And possibly how often do people buy? Do they come in come 3 times a year, or 4 times a year, or once a year, or whatever's relevant to your business? Okay, so it's important that you determine which KPIs you should be measuring, and then set goals for improvement and establish a dashboard to regularly monitor how you're progressing. Okay. So when you set goals, do you have someone to hold you accountable for what you've committed to? So, and what are the consequences for you if you don't achieve your goals? Take a minute to think about that. You've done the hard work. You've done your business plan or your business recovery plan. You've done your financial forecasting. You've looked at your KPIs. You've decided which are the most important ones. But what's the point of doing it if you don't actually do it? And so what would happen? We did this with one client once. We did this exercise. What will happen if you don't do it? And they came back and said, we'll end up working in a shop. They didn't want to do that, so that gave them an idea of motivation to actually do it. And to help them, they have an independent coach, if you like. So if you've got somebody who does that, do you have a soft coach? Somebody who goes, oh, well, yeah, never mind, you didn't do so well, but so what? Or a hard coach, or somebody in the middle, somebody who will just hold you accountable. Some clients say to me, I'm always worried when I'll have slight nervousness when we have our coaching sessions if I haven't actually done the things that I've said I would do. So it gives them an extra impetus to actually do it. So remember, one of the 5 A's of change, one of them is accountability. So you must have someone independent to hold you accountable, to make sure you do the things that you say you're going to do. Now, some people say, well, my partner, wife, husband, whatever, will do that for me. My experience is it doesn't usually work very well. It can either lead to big arguments or just not enough accountability. So think to yourself, is that a good idea? So it says they're maximizing fuel efficiency, minimizing wear and tear. The car metaphor keeps going. But to summarize, if your business is the vehicle that delivers to you what you want in life, and the top 4 things you need to make sure you do these are: set an annual plan. Now, that's not just a financial plan, that's a plan that says, who are our customers, what's important to us, what we want to achieve in the year, not just the numbers. Then set an annual budget, which is the numbers. These are the things that can be measured. Remember, what's measured improves. Set and measure your 4 to 5 most important KPIs. Like we saw a minute ago, it might be gross profit percentage. A lot of the clients we work for, as I said, the gross profit percentage is one of the most important KPIs in the whole thing. Have someone independent to hold you accountable for your actions and make sure that you carry out your plan. Now, I'm going to get on to the 7 ways in a minute, but just very quickly, I want to talk about the marketing flywheel. And that's just it's important to understand that, because it shows you how to attract, engage, and delight customers. It demonstrates that you shouldn't just focus on new customers, but you should also focus on delighting your existing customers. So first we have strangers. These are people who haven't heard about your business. They just don't know about you. So we can do some marketing to get them to become aware of us, who then they will become prospects. Now, if they're aware of us and they identify that we can solve a need or a want that they have, they will become customers. And if we treat them really well, they'll become promoters. The more promoters we have, the more people we have that are going to go out and speak to strangers about our business. So the cycle continues. So if you think about a restaurant, which maybe isn't the best example in the current situation, but it's an easiest one to understand. You're at the beginning, the new restaurant opens, you don't even know about it. Then you might see some advertising or somebody might mention it to you. So you go along, you think you become a prospect, and you go, I'll go and have a look, I'll see what's going on. You go and you have a nice meal. It's great food, great setting, great service. Then you are definitely a customer. And then because it's so good, you go telling friends and family, etc. about it. You become a promoter. So that's the cycle that we're talking about here. So in order to attract prospects to our business, we need to provide some sort of value before we can extract value. Think about what they'll get from doing business with you and the problems you can solve. To convert prospects into customers, we must engage them by making it as easy as possible for them to buy from us. Our marketing is what attracts and engages prospects and turns them into customers. Our sales processes, and by that we mean it's basically tied up with the delivery of the goods, how we actually sell them and deliver what the goods or services that we deliver. So they should be so good that the customers keep coming back, they're delighted. And then the delighted customers will share their feedback with strangers, creating more prospects, customers, and promoters. And the level of service we provide customers determines how we delight and attract current and future customers. So the aim here is to keep the marketing flywheel spinning as fast as possible, converting more strangers into prospects. Those customers become promoters. Following this process is essential to growing your business. So the 7 ways to grow your business. So we've set the grounds, we've set what you need to do to the very minimum to be able to grow your business. You can't just do the 7 ways on sand, as it were. You can't build it on sand. You have to have these things in place, in my view anyway. So the first way to grow your business is to increase the customer retention rate. Now, we talked about that a minute ago with the marketing flywheel. They say it's much cheaper to make sales to existing customers. In fact, statistics show that it's 6 times easier and cheaper to make sales to existing customers than it is to new customers. By delighting our customers, we make them want to come back, and therefore increasing our customer retention rate. What do you do to delight your customers? Spend some time thinking about that. You can follow the FGG principle, which is to delight your customers, find out what they want, that's the F, go get it, that's the first G, and give it to them. Okay, the second way to grow your business is to generate more leads. Now, that's often what people think is the first way, but the first way is to make your existing customers happy. Second is to generate more leads, and this is what we normally consider marketing. The best way to generate more leads is to delight your customers, as I said, so they become promoters. But that might not be enough for your business. It depends what your business is. It might be that you have to then do some more marketing. So in other words, you have to attract the strangers using your marketing strategies and providing value. One way to provide value is to share content, information, useful stuff that people like, and do it for free. It shows who you are, what you can do, and it gives value to people. And then when they need a bit more help, then they'll come to you. So as I say, it might be a free download on your website, or a free trial, or a consultation. If you show them the problem you'll solve if they engage you in your service, they're more likely to come to you. So the third way to grow your business is to increase your conversion rate. Now, the conversion rate, if you think about it, you've got your leads, number of leads coming in, and leads are effectively prospects, and conversion is the sales process. So how do you convert more of your people who come to you to actually buy, to become customers? Do you measure how successful you are at converting leads? And it could be quotes or proposals, or how do you get them into sales? And if you feel that you're not getting a very good conversion rate, do you review why you aren't doing it? So if you monitor the conversion rate of, let's say you've got a sales team. I mean, I know most people here probably don't have a sales team as such, but if it could be that it's the way that you sell. If some ways of doing it or some people in your team are doing better than others, find out why. And it might be that you're not using the right people in the sales process, but these are all questions you need to ask in order to be able to increase your conversion rates. There's a few points here. One is to say that if you're going to try to sell, essentially convert into a customer, you really need to be dealing with a decision maker, and you see that quite often in certain bigger companies that you're speaking to the wrong person, and that's one thing. You really make sure the decision makers are there. Another example of things you can do is maybe to have a range of options, so that the question that the customer or the potential customer is asking is, which option should I buy, rather than should I buy? Now, there's one point I always like to make about conversion rates. Be very careful, because if your conversion rates can be too high. So what do I mean by that? I mean, if your marketing is attracting prospects who aren't your ideal client, do you really want to convert them all into customers? Probably not. So if your conversion rate is 95%, it may be that your prices are too low, or you're a really good salesperson, but it could end up with the wrong types of customers or clients. So just bear that in mind when you're looking at it. It's about getting the balance, attracting the right leads and prospects, and converting the right ones at the highest level possible. So the fourth way to grow your business is to increase the transaction frequency. Now, in a minute, I'm going to give an example, so bear with me. I know this seems a bit abstract maybe at the moment. Transaction frequency is essentially how often people buy. So as I said earlier, it's much harder to sell to new customers than it is to sell to existing customers. So it makes sense to encourage those customers you already got to buy more often from you. Again, obviously it depends on the nature of your business, but if it's the sort of thing that if you can sell more frequently to customers, then you should encourage them to buy more often. And you could do this by sending reminders, having VIP schemes, or maybe special deals to existing customers. One of the things that I always think of in these examples is Amazon. If you buy something in Amazon, which I suppose most of us are doing at the moment, you get emails straight away, next day, how was it? People who bought this also bought that. There's a whole mechanism there, an algorithm that encourages you to go back and buy more. So the fifth way to grow your business is to increase the transaction value. So you might think that doesn't mean increasing your prices, and that could be one way. If your prices are too low, increasing your prices might be one way to increase the transaction value. But there's other things you need to do. You need to focus on the value you give your customer so that you could increase your prices. Think about how you could add more value to your customers. Could you provide them with a range of options? Is it clear what your business offers? Do you assume they already know? Tell them. Follow the classic, would you like fries with that? In other words, just ask people, and they might spend more. They might not have thought about it. You can adapt this to your business, obviously, because all businesses are a bit different. The final point on increasing the transaction value is try not to offer a discount. Discounts are usually a race to the bottom. And on the value equation, which I won't go into just now, but essentially you've got two things. You've got the price and you've got the perceived value. And the perceived value has to be more than the price for someone to buy it. So there's two ways you can do it. You can reduce the price or increase the value. If you reduce the price, then that hits your bottom line. A £10 discount on a sale is £10 less profit in your business. Whereas if you can increase the perceived value of what you're providing, people will pay more for it and won't need a discount. Okay. Sixth way to grow your business is to reduce your variable costs. And this goes back to the point about gross profit percentage being a very common, important KPI for many businesses. Your variable costs are the money you have to spend in order to get any particular sale. So, for instance, if you're selling, let's think, you're selling a kettle. Now you're going to buy a kettle from a wholesaler or possibly manufacturer, depending on the situation. So you pay for, so let's say you pay £10 for a kettle. It's probably less than that, but £10 for a kettle, and you sell it at 30. Now, if you could reduce that £10 a bit, that would mean, and you still sell it for 30, you're making a bigger gross profit and a bigger gross profit percentages. That's one way. It could be you have to implement better systems to record the amount of labor involved in your business. You know, if you're an electrician, you have to make sure that you're not undervaluing the labor when you create your pricing for a job. And some businesses, you might want to introduce strategies to reduce the amount of rework and wastage. All these things will help you reduce your variable costs. And the final way to grow your business is to reduce your overheads. Now, overheads, very simply, your fixed costs like your phone, your utilities, rent, office supplies, all these things. So I would say that it's worth looking at your overheads, because sometimes you buy things or you enter into contracts and these contracts continue. I mean, a classic one is mobile phones. You know, you pay £50 a month for a phone, but you come on contracts for, say, 2 years, but you just keep the phone and you keep paying £50. Whereas if you got a SIM only, you know, it might cost you £10. That might not be a lot, but if you've got a lot of phones, it can add up. So these sort of things, just look at them, be sensible. I also think that you have to be careful when you're reducing your costs, because there's a lot of the point about, what's it called, the law of unintended consequences. Just be careful when you're thinking about going to a different supplier. It might be the quality is less. You might not be getting the same for the same money. You might be able to negotiate better terms for utilities and rent. At the moment, there's a lot of negotiations going on with landlords about the amount of office capacity that's not needed anymore. So while we're on the subject, I was going to talk about accounting fees. So we're telling you to reduce your costs. So you think that we are just a cost, then you should cut our costs. But what I would suggest is that by working with us as a strategic partner in your business, you need us now more than ever. Think of us as an investment rather than a cost. Our goal is to save you more tax and help you to grow your business in the way that you want. And it should be, and what you get will be much more than any extra you pay in accountancy fees. So the growth equation, this is the model I mentioned at the end, a mathematical. In fact, it's a bit less than a mathematical, it's an arithmetical model, because it's only really adding, subtracting, multiplying, and dividing. So it's a calculator that we use to show you how small changes in each of the 7 ways can have a huge impact on your profit. If you monitor your KPIs, you can set goals by monitoring your KPIs, you set goals for your improvement of your business, and the calculator shows you the 7 ways to grow your business in action. So what we've done, because it's a webinar, we've used screenshots for the calculator to show you an example. We can actually, if you're interested in this, we can sit down and run through your numbers to see the impact small changes will make for your business and determine the goals for improving your KPIs to achieve that new profit. So let's have a quick look at the current KPIs and profit for this example company, and then I'll show you the impact that really small changes make on the profit and the value of the business. Important to say that the numbers have all been kind of rounded just to make sure that it's easier to understand. So if you're a mental arithmetic genius, don't worry pointing out that they're not quite exactly right. They've been rounded. So let's get started. The company had 765 existing customers. So we're looking first at the retention rate. That was the first way to improve. So the retention rate here is 85%. So from one year to the next, they keep 85% of their existing customers. And that means it goes from 765 to 650. Okay. Second way, the number of leads, inquiries, was 145. The third way, their conversion rate was 50%, so that half the leads became customers. So they acquired 73 customers. So their total customers was 723. Now, each customer makes on average 1.1 transactions per year. And you can work that out quite easily just by looking at how many customers you have, look at your turnover, how many invoices are raised throughout the year compared to the number of customers. Very easy to do. So the average transaction value was £780, and this results in annual sales of £620,120. Okay. The last two ways to improve were the cost of goods sold. That's the direct costs, you remember, and we're saying that 70% of the sales goes towards the costs of actually making that sale. And their overhead expenses were 132,500. So that's basically the rent, the rates, the utilities, etc. we mentioned a few minutes ago. And this leaves them with a net profit of £53,536. Now, you'll see it says their valuation £160,608. Now that's just a very basic multiplier of 3 times profit. Now, for some businesses, that is pretty close to what you actually get. So we're not saying this is the way we would do a value of a business, but it does provide an indication of the value for a very rough sort of way. Okay. So what changes could this business make to improve its profit and therefore its value? Now, remember, the first way to grow your business is to increase your customer retention rate. So let's say maybe they've put in a loyalty program, or maybe created a customer Facebook group. It would depend on what type of business is, but this results in a slight increase to 90% retention rate. So they've retained an additional 39 customers. Okay. Now, they've not done any extra marketing or etc., so they get the same number of leads as the previous year. And in fact, their conversion rate's gone down, and that might be because of the economic situation at the moment, whatever. So they've only acquired 65 rather than 73. So their sales and marketing is less successful than the previous year, but their retention is better. So as a result, the total customers are now up to 754 pounds. Now, the customer loyalty program means that they now make an average of 1.3 transactions. So they've increased slightly the number of transactions, but the average number of transactions for each customer they've got. And they've also managed to implement systems that means people buy a little bit more when they buy from you. So the sales have now increased to 784,000, pretty close. Now, if the business then negotiates better terms with its suppliers and improves its maybe stock management processes, they might let's say they've managed to reduce the cost of sales, the cost of goods sold rather, to 65%. Now, some of these changes came about, let's say, due to additional coaching from an accountant, the accountability part, but that means that their expenses have increased. So as well as the additional investment in their accountant, there's also an increase in wages, etc., to deal with the bigger sales. So expenses have increased to 150,000. So you can see that the only things that have actually improved are the retention rate, number of transactions per year, transaction value, and the cost of goods sold. So not every aspect, not every of the 7 ways. In fact, some have actually got worse. Now, what do you think the profit will be? If there is anybody there that's got excellent mental arithmetic, probably work it out. I'll just show you now. The new profit, £124,365. That's an increase of £70,000 on the previous year by not doing an awful lot, really. And if you look at the valuation of the company on that very rough and ready sort of way of doing it, it's now 373,000. There's an increase in value. So if you sold the company, 200,000. And remember, that profit improvement will continue each year. and might even get better. So you can see the business only really had to make quite small changes, but they've more than doubled their net profit. So by focusing on delighting your customers, you keep more of them, and are more likely to buy from you more often and spend more when they do buy from you. Remember, this is just an example client, and your numbers will be different. We can actually meet up with you to input your numbers into our growth equation calculator to work out the impact small changes could have on your business. So, avoiding insanity. As it says there, insanity is doing the same thing over and over again, but expecting different results. So, it seems obvious when you think about it. So what do you have to do differently this year, coming year? I think we've got 4 choices. First one, do nothing. Nice webinar, maybe. Yeah, I know I should probably do some things, but the whole change thing, it just seems too much. It's just far too much. I can't do it. You could retreat, so which means you try a few bits and pieces, try a couple of things, have a couple of bad days, and then just go back to doing what you were doing. You could take normal amounts of action. So you do a few of the easier bits here and there and get some quick improvements to maybe your cash flow, profitability. You haven't really fundamentally changed your business. You haven't really got drilled down right into the nuts and bolts of your business and made the changes you need to make. So an awful lot of these quick wins will probably evaporate along with the quick cash. And the fourth option is to take massive amounts of action. So what that means is you're aware that you need to fundamentally change your business because it's here to serve you and not the other way around. So many people I see in businesses, they start their business off as this is going to enable me to get all the things I want out of life, whether it's time, whether it's peace of mind, whether it's profits, money, and it doesn't work. They end up 3 or 4 or 5 years later working long hours still, really stressed, not having enough money for things. So by taking the right actions, you can fundamentally change that. So as the old saying goes, if you do what you've always done, you'll get what you've always got. We know you can't carry on doing what you've always done in the current environment. If you do what you've always done, you're actually probably going to get less than you used to get. So how can we help? Now, what I would say is that this educational webinar is very general in nature and is no substitute for specific tailored advice and support. Now, a lot of people, and probably a lot of you, will be able to go away and do a lot of this stuff yourself, and I really encourage that, and I hope that this webinar has shown you the sort of things you need to do. I mean, that would be brilliant, because what our passion is to help small businesses improve and the owners of the small businesses to get what they want from their business. That is what we're here for. That's our purpose. That's our why. But there are several ways we can actually help if you feel that you need to help. So if you haven't done a business plan, we can work with you to develop yours over, it's usually a half to a 1 day session. Sometimes it's like 3 hours in the morning, a bit of lunch, then 3 hours in the afternoon. If we do it over Zoom, obviously you have to bring your own lunch. If you need a bit of accountability, we can do, and that's to make sure you stay on track. We've got a lot of knowledge at Roslin Associates and a lot of experience and a lot of coaching skills that we can use to help you achieve what you want to achieve. So we've got on the screen there, we've got quarterly coaching. That's basically what it says. It's meeting every 3 months to make sure your plan is going to plan, as it were, and hold you accountable. There are different sort of packages. We work with some clients on a monthly basis. That's probably the most common one, because the month is a nice time for a client to go away, do the things they've got to do, but it doesn't leave it too long before they're brought back on track if they've gone off track. We've had clients in the past where we've worked weekly because they felt they needed a bit of intensive care, but that is fairly uncommon, to be fair. So we're also offering all attendees to this webinar the opportunity to complete a 7 ways to grow business action list. And this allows you to identify the actions you can take to grow your business. We'll then have a 15-minute complimentary call where we'll review your completed action list and ensure you've identified all the actions relevant to your business and that you have a plan to implement these changes. So I really would encourage you, if this seems something that is important to you, that you can apply in your business, the action list, I think Ikra mentioned at the beginning, when we finish the webinar, we'll be having, we'd ask you to complete a feedback form, and on that feedback form, you can ask for a copy of the action list, and then we'll get that to you. And then once you've completed it, let us know, and we'll arrange a short call just to see how you're getting on and see what, if anything, we can suggest that you do differently. And finally, a complimentary meeting. What that really means is it's 1 hour. We do this for our clients. It's part of our service for our clients, but we also do it for people who aren't clients yet. We offer a 1 hour meeting to establish if we're the right fit for you. And at that meeting, what we do is we look at your business goals, what it'll mean to achieve them, what it'll mean if you don't. We'll look at what the steps you're actually taking and what you can possibly do, and if we can help in any way. So we'll move on to questions. And Ikra, do we have any?
Yes, we do have some questions.
Excellent.
I'm unable to share my video, so sorry about that. But you can hear me okay?
Well, I can hear you.
Yep, perfect. Okay, so we do have a few questions so far. And again, if anyone's got any questions while I'm reading these out, please do just fill them in the Q&A box. So first question we've got, Ian, is how do you recommend to keep a track of KPIs, and how often would you measure them?
Oh, that's a good question. To some extent, it depends on what the KPIs are, because you tend to have, I mean, financial ones are obviously very important because they're probably the easiest ones to measure. And you would probably measure them by getting reports from your cloud accounting software, such as Xero. And we use other software to extract the data from Xero to report on what KPIs essentially. So, we can sort of look at it and say, let's say gross profit percentage, we can track that on a monthly basis. And I'd say, to answer the second part of the question, I would say that, again, depends on your business, but I would say that you want to do it at least monthly, because, if you're going in the wrong direction, the more often that you check that you're not is, the more likely you are to stay on the right track. If you leave it 6 months, you could be miles away from where you plan to be. If you do it weekly, it might just be over the top, and it might actually not be helpful, because you might have different sort of sales patterns or different sort of things happening at different points throughout the month. Or doing it weekly would be a little bit, distorting in a sense. It might make you panic when you don't need to. So probably mostly monthly, I would say. Now, just to finish the question, there were some, there are some non-financial KPIs potentially, which could be things like, how many blog posts did we do? And that's really just a case of finding whatever the easiest way is to track it. If you're aiming to do 4 a week, then you can just go, if you can count to 4, you can track it basically. And then you might do it on a spreadsheet or something like that, compare it to your target. Hope that answers it. Okay.
Yeah. We've got another question here. I am having some cash flow issues at the moment. Do you offer any payment plans?
Yeah. If we go back to the middle of the webinar when I was saying, basically don't discount. That is so it's quite an important thing to remember. So we wouldn't discount. Our clients wouldn't expect us to do something that we're telling them not to do. But what we can do, and if the situation is right, we can talk about maybe spreading the cost a bit. One of our key values to be creative is creative thinking. So it's about finding out what the real issue is with the person that that sees the value in what we do and wants to take part in it. But what's stopping them? If it's cash flow, how can we help that? There's lots of different ways we can do it. I mean, I've done things like say start off on a low amount or lowish amount, then go up to a medium amount and then a higher amount, so that by the time the whole thing's finished, the correct amount's been paid. So yeah, the short answer is there are things we can do, and we like to be creative in that.
Yep. And we've got another question here. I am keen to use some of these services, but I am a bit wary it won't work. Can you give me some reassurance I will get a return on my investment?
if only everything in life was certain. No, sorry, I don't mean being flippant. I mean, I absolutely understand that. We're a business ourselves. We have to buy services, etc., and we have the same feelings. It's like, are we sure we're going to get, whether it's marketing or IT support or whatever, how do we know that when we commit to this, we're going to get value for money? And you don't. You just have to go on, maybe testimonials from other people, etc. One of the things we do that to sort of make it easier is, if someone says, right, I want to do monthly coaching with you, and we'll usually ask them to commit to a certain number of months depending on the situation, because one coaching session is not going to do much. So what we do is say, right, at the end of each, when we sign up the whole thing at the beginning, we say at the end of each coaching session, if you're not happy that you've got value out of this, then we can just stop now, and you don't have to keep pay for the subsequent ones. That way, it means that you're not, even if you're committing to 6 months, you're not really committing to it if you're not happy. And anyway, we'd hope that people would speak to us rather than just say, I don't want to do it anymore. But that's another issue. So the other way, I suppose, is our experience is that by working with clients, they do become more successful, and the feedback we get, I mean, we do have testimonials. We probably under publicize these, but we have testimonials for one client, for instance, we were working for about, I think it's about 3 years. They've gone from 200,000 turnover to pretty close to 1 million, and it will be 1 million in the next few months. And their comments were, you've been absolutely fundamental to what we do in our business. We now understand our business better. We understand the finances of our business. We understand the importance about planning and values planning, all sorts of things, organizational structures, all these sort of things can be brought to the client. So the short answer is you can't be sure that it'll work, but our experience and the clients that we work with experience is that it does. So that's that, I suppose.
Yep, thank you. So that's all the questions that we had so far. And just a quick reminder, if anyone does need to leave, that there will be a feedback form to please fill that in. And if you do want the free checklist that Ian mentioned, please put that on the form and we'll get that emailed across to you.
Okay, thanks, Ikra. So before we go, I thought I'd share this quote with you. Jim Rohn was a well-known sort of personal development guru. I mean, he was one of the gurus for Tony Robbins, for instance. Success is neither magical nor mysterious. Success is a natural consequence of consistently applying basic fundamentals. And I hope in this webinar, we've shown that there are some fairly fundamental things that you can do, and if you consistently apply them and have accountability, you will be successful. So I would suggest you make a simple plan today. Go and commit to at least 3 actions you'll take as a result of today's webinar. Write them down, give each of them an owner, who's going to do it, and a completion date. And remember, if you need our support, we are here for you. So thank you. Thanks for making the time to attend this webinar. We really appreciate your time. It's very valuable. Please complete the brief exit survey so that we can continuously improve and get our feedback on what other webinar topics you'd like to see from us. We hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. Thank you.